Lyn Alden of Lyn Alden Investment Strategy is back to give us her economic outlook and talk about cryptocurrencies. We'll start with Bitcoin again this time. Lyn, welcome back to the show.
Hey, thanks for having me. Nice to see you in the new year.
Nice to see you too. Lyn, I know you've been very busy, and we'll talk about all these different things that have been keeping you busy. But first, I'd like to address a very interesting article you wrote recently, which is whether or not Bitcoin is a Ponzi scheme. First of all, I think I know where you're going with this, but why don't you give us a synopsis of what this article is about?
Yeah, so I kind of walked through the different definitions of a Ponzi scheme. And, for example, the SEC has a good list of what defines a Ponzi scheme and what some of the red flags are looked for. And the reason I did that is because one of the common criticisms of Bitcoin is that it's a Ponzi scheme, that it only, you have to keep, people have to keep buying into it in order for it to do well, which of course has some degree of truth to it. So I went through it and kind of looked at it point by point. And you can kind of break that into a narrow definition of a Ponzi scheme, like an outright fraud, versus a broader definition of it. And so from the narrow scope, one of the things I looked at was kind of the whole launch process of Bitcoin. And so what we saw, for example, was that the creator or creators, we don't really know if it was a person or a group, but Satoshi Nakamoto, it was interesting because they released a white paper pretty much showing how to do it before they launched it themselves. And so rather than kind of keep all their secrets to themselves and then launch it, they released the white paper. They got criticism on it. They kind of had some interaction with other experts in the field, almost like a thesis defense in a way. And then they went ahead and launched the software, and then they gave themselves no pre-mine. So they didn't give themselves coins and then launch it. They had to continue to mine it just like anyone else on the network. So they had really no inherent advantage. And that kind of contrasts to a lot of the ways that later tokens launch themselves. A lot of them use pre-mines, to their founders and their initial investors, whereas Bitcoin was launched more like a protocol rather than more like an investment. And so,
right.
By most metrics, the narrow definition doesn't really apply. And then the broader sense is just the idea that, really any non-cash flow producing asset is only worth what you think someone else is going to pay you for it in the future. And that's true for Bitcoin, that's true for gold, that's true for, fine art, beachfront property that you don't plan to rent out. All these kind of high-end kind of scarce goods, they're always based on, their scarcity and their desirability. And so it kind of goes through and just compares Bitcoin to some of those other things. And one thing that they all have in common is that they have some degree of utility, right? So, fine art has utility, a classic car has utility, beachfront property has utility, gold has utility, but they also all have a monetary premium associated with them. And so they're bought for, more than just their utility. And Bitcoin's kind of a similar way because for its utility, you have, permissionless international payments that pretty much can't be stopped and easy mobility of funds, right? So you can just remember a 12-word seed phrase and go anywhere in the world, across borders, and basically transfer wealth wherever you want. That's its utility, and then it has that monetary premium due to its scarcity. And so the overall point of the article is that Bitcoin still has a variety of risks. It's going through an adoption period, and we'll see how far it gets. But it doesn't really meet the definition of a Ponzi scheme more so than any other kind of non-cash flow producing monetary asset.
I think the word Ponzi scheme may also be used loosely to describe something that is not inherently trading at fair value or is difficult to value in the first place. You mentioned assets that don't generate any free cash flow. Well, Bitcoin is one of them. You mentioned art, for example. Well, if I go to an auction and buy a famous painting for $1 million, well, who's to say that I overpaid or underpaid? How can you value something like that?
Well, that's actually one of the most challenging things with a non-cash flow producing asset. And so the same is true for gold. And so, for example, with gold, what I do is, because it has a long history, I compare it to the broad money supply growth, based on the premise that, the amount of gold per person doesn't really change much over time. It's mined actually almost at the exact rate of population growth, ironically. And so there's about 1 ounce of gold in the world per person, which is estimated. And so as the amount of fiat currency multiplies, you'd expect gold to roughly keep pace with that. Of course, it would undershoot it and overshoot it, undershoot it as sentiment changes, but roughly it keeps up with that. And that's what we see in history. A similar thing, beachfront property, you have these periods where it goes up very rapidly, but then if it gets overvalued, it kind of goes out of favor. And so with those things, it's quite challenging to value them because they don't have cash flows. You have to kind of estimate their attractiveness compared to other non-cash flow producing assets. And you can do things like compare the size of those markets compared to the expansion of the fiat money supply. And with Bitcoin, it really really comes down to estimating how large it'll be when it's kind of finished this adoption curve. Like, some people say it'll be half as big as gold's market capitalization. Some people say it'll be as big or bigger. And, either way, it just comes down to estimating how big it will be. And then from there, you'd expect it to roughly grow at the rate of broad money supply increase.
Well, that assumption factors in constant growth of price for gold, right? Assuming gold doesn't collapse in value. Half of something that's collapsed in value is still not going to go up very much. Going back to gold and Bitcoin as assets that don't generate cash flow. All right, well, would you agree with the notion that in that case, the market is always right in determining the price? If gold is trading at 1835 today, let's say, then that's because the market has bid for that price and deemed that to be the fair value at any given moment. Likewise, if Bitcoin is trading at $40,000 a coin, that should be the fair value because the market at that point has indicated that should be what it's trading at, or what it should be trading at. How would you respond to that?
I think there's some truth to that, but of course we can always go back in history and find where, in the short term, the market can be silly. And there's that quote from, long ago where, in the short term, the market's a voting machine, but in the long term, it's a weighing machine. And so the market is more prone to, having errors in the short term. Like, for example, if you look at the dot-com bubble, there were companies trading at absolutely extraordinary valuations. Rather than just the Cisco's of the world, there were some smaller companies that were trading at absolutely silly valuations. And we're seeing some of that today, actually. And so you can have these periods of time where something trades at an irrational valuation because there's so many people that want to get into it. Or you can have the opposite where no one wants to touch it and it's kind of like toxic and it's super cheap.
Right.
But over the fullness of time, I think the market kind of weighs things. And so we've seen for 12 years now how Bitcoin has changed in price by the market, especially compared to some of the other tokens. And same for gold. I think gold, I consider it fairly valued at this time. I think it's doing what we'd expect it to, even though I expect in the years ahead, I think it'll do pretty well when I see that we're probably going to have lower negative real yields.
Okay, I think going back to the Ponzi scheme argument, if you were to consider that in the dot-com bubble, valuations were silly because these companies weren't actually generating any cash, but they were supposed to be. They weren't producing any output, and yet they had ridiculous valuations. That makes sense to me. But let's say Bitcoin tomorrow, let's say all the hodlers of Bitcoin decide that it should be worth $20, and so they push the price down to $20 a coin. I think that's the risk that investors are considering, that this group mentality, this herd mentality of irrationality could just all of a sudden push prices in either direction. Well, could you see that happening?
Well, Bitcoin is certainly one of the more volatile assets out there. And so that's really true for any kind of monetary asset. And so we've built up fine art prices to very high levels. And we could see, next year that a lot fewer people want to buy that fine art. And suddenly, they all kind of, millions of them come to the realization that they should pay a third as much. And so, that's one thing to monitor. Same thing, there are $40 million beachfront homes, throughout Florida. And you could find out that, maybe, next year they all want to pay $10 million for those. And it's, it's certainly possible, but there are a lot of on-chain indicators you can use. And so, for example, we can see what long-term holders are doing with Bitcoin. And we see that as the price goes up much, much higher, they're slowly willing to sell, some of their tokens because they've gone up 5x or 10x in some cases. But you don't see a lot of kind of movement from those long-term holders. A lot of those intermediate term, kind of like the near-term kind of price volatility, a lot of that has to do with the trading activity that we see on exchanges, whereas the long-term holding is actually kind of a steady thing to watch, similar to accumulating other types of property.
Okay. And final note on Bitcoin, you were bullish last time we spoke a few months ago. Are you still bullish now?
Yes, but I mean, it's tempered somewhat by how well it's done. And so, for example, last time I was in your program was mid-December, and I said if it breaks over 20,000, then the bull market's back on, and I expected it to. I'm watching the $20,000 level really closely because until it breaks over there, it's at risk of further corrections and consolidations. But once it punches over 20,000 firmly into new all-time highs, the ceiling above that where it can go is rather high. And now since then it's more than doubled. And so I see a similar situation now where the resistance number is somewhere around 50,000 because that's a psychologically important number. Mm-hmm. It's a round number. You can look at there's sell orders in at that level, and so that's kind of a resistance level level that it has to break through in order to continue the bull market. And my base case is that I think it will continue the bull market in 2021. But the higher you go, the less asymmetric that trade gets, with any kind of 12 to 18 month view compared to how it was last year.
And would you consider investing in any of the other altcoins that maybe have smaller market caps but also upside potential?
So personally, no, but I can see why people do it, because during the bull runs, a lot of those alt tokens tend to, even outperform Bitcoin in many cases in terms of percent gains. The problem that you run into is on the down leg of the cycle. Bitcoin's volatile enough, but some of those altcoins fall even farther. And then unlike Bitcoin, that it goes through this 4-year halving cycle, keeps making new highs every cycle. A lot of those other altcoins, after they have their blow off top, they never recover in later cycles. And so really the two big ones are Bitcoin and Ethereum. But as you start venturing down to some of those other tokens, that gets increasingly risky, and people should be aware of the risk they're taking on if they want to go outside of Bitcoin, essentially.